Good day, fellow investor. IBM is one of the most horrifying stocks over the last 10 years because of its performance. However, we are now in a situation with close to 10% cash flow yield, 5% and higher dividend, and the CEO promising hybrid cloud growth. It's time to analyze, even if you have been an IBM shareholder, you are disgusted by it. I've looked at more than 30 analysts' reports over IBM because I wanted to feel what's the market sentiment over the stock, and I have first summarized it all. That will give you a clear perspective on the stock and what's going on. Then we'll make a normal analysis on the stock, valuation, risk reward, and you'll see whether this 5% dividend yielder, promising growth, huge market, huge company, fits your portfolio. So the first negative reason is that it's not just lagging peers when it comes to growth, it's terrible. IBM's revenue growth went from 106 billion in 2012 to the current 75 billion. They lost more than 25% of their revenue over the last 8 years. That's terrible. Consequently, also net income from 2013 went down from approximately 16 billion to the current 8 billion. Long-term debt went just up, and up from 20 billion, normal 20 billion, no debt at all compared to the 16 billion net income, to the current 55 billion, especially after the Red Hat acquisition, on no improvement in income. Then we have beating analysts' estimates only 2 times out in the last 8 quarters. Revenue estimates are down due to COVID. Earnings per share estimates are down also due to COVID, but still at $13 per share, which gives you a price-earnings ratio of around 10 or even less than that. Of course, the company is reducing employee count constantly, and one of the examples of skill loss is Lisa Su, currently the CEO of AMD, that has a market capitalization close to IBM's now. That's very interesting. Then the CEO, Romati, went from a compensation of 16 million in 2012 when she became CEO to 158 million in 2019, while the market capitalization simply disintegrated. To me personally, when I see a picture like this in the annual report, I think this is not about shareholders. I think this is about, I don't know, just the management making money, and she made her 158 million in 2019 while the company completely underperformed. Other reasons were Buffett buying in 2011, taking a look, selling, then a split, so they are focusing not on what's going on with the business, they are focusing on pleasing Wall Street with splitting a company. No reason to do that, hoping just that Wall Street will take a look, different look. There will be no buybacks till debt ratios improve, so that's again something that there is no catalyst for the stock. Quantum computing will not create profits in this decade, and there are many other concerns like the competition, especially in cloud, simply making it impossible for IBM to live and work. However, the cash flow yield is there, the dividend is there, 90% of your credit card transactions go through IBM infrastructures, etc. So IBM is still IBM, and we have to look at it not from what happened in the past, which influences the stock price, but from what will happen in the future. And the CEO is very positive. He expects to deliver mid-single-digit growth upon the completion of the separation of the new company. We'll see if he will be more successful than Ginny in the last 8 years. Let's discuss the business. So IBM, new company, managed infrastructure service company, and the largest hybrid cloud company. This is what they are splitting. And another issue with IBM that I see is the following. I've listened to the last conference call, and you can see here that IBM says how they could not do the deals they wanted to do because it might have been diluting their margins. So they would not make an acquisition because the margins they had would go down. Now, when you are in business, do you care about your margins, what Wall Street sees them, or do you care about making more and more profitability? They didn't do any acquisitions except for Red Hat now at the end over the last 10 years because they were focused that their ivory tower margins would be brought down. Of course, others took those, did that, and destroyed IBM over the last 10 years. And they hope that after the split, each company will be able to work better on their own without what they think that Wall Street thinks about margins. Amazon didn't care about margins for 20 years, and we have seen their result compared to IBM. Another issue to think about, interesting learning issue from a margin perspective, Wall Street and simply business making money. Of course, clients are there, 4,600 clients, good backlog, so it should be stable, at least this company. On the other hand, the hybrid cloud solution should lead to 1 trillion market opportunity that should offer growth. Revenue will be split 59 billion, 19 billion. That is what, 78 billion. Now we're at 75, so a little bit less there. We'll see how they're divided, but the dividend policy is expected to remain stable there. Also, they have amazing clients all over the world. As I said, stable, especially mainframes, etc. And big banks will not change their providers because of too much risks of changing or just going to the cloud, etc., etc. So it's IBM, therefore I think the dividend will be stable, but will it do good or will it grow? That's the main question. If we look at the fundamentals, of course, they grew their dividend. The dividend yield went up, up, and up as the stock price declined from 180 down. So, okay, let's see what will happen in the future. If this keeps growing, then this should follow too. And the fundamentals are pretty simple. We already discussed 55 billion in debt, which is huge compared to 12 billion in free cash flow. That's 4 or 5 years of free cash flows, and it doesn't really give them the opportunity to grow through more mergers and acquisitions now, so they have to first lower the debt. But if they focus on lowering the debt with just 12 billion of free cash flow, of which 6 billion have to go for the dividend, there's just 6 billion to lower the debt. It will take 5 years to bring it back to 24 billion, which is something, let's say, acceptable. So the debt is certainly a fundamental issue, but still, if we put it into a mode perspective, then the dividend is relatively safe. And we could say the fundamentals are stretched, and it will all depend on what happens in the future. If they grow the free cash flow, then the debt will not be an issue. If not, then the debt will become an issue, and this is one of the biggest risks with IBM. On buybacks and dividends, this is really insane. IBM has spent more than 200 billion on buybacks over the last 30 years. That's almost twice the market capitalization. So in this case, buybacks really didn't work as planned, especially as the company didn't beat the market. Or did it? If I compare IBM over the last 5 years, it was terrible, down 10%, while the S&P 500 was up 76%. But if I look at this from a longer term perspective, if I look at from 1993, then IBM didn't really underperform the S&P 500. So from 1993, those buybacks worked, especially for those who sold in 1998, but also for those who sold in 2013. Buying here was a mistake. So there is hope for IBM. There are these low points that bring to high points in a cycle, and we might be there. So you have to see whether it's time to buy now and wait and go through all the ugly that we discussed for a possible upside. That's the interesting story behind IBM, despite all the bad numbers shown. On a valuation and investment conclusion, I have looked at the cash flows, and we have free cash flows of around 11-12 billion, conservatively 11, that lead to 6 billion for dividends and 5-6 billion for free cash flows. They will lower debt, okay, create value for shareholders by lowering debt, so that's good. And this is a 9% cash flow yield, which is not bad. If the company stays stable, if everything stays stable, then this will be a great investment, especially if they hit the 5% target, growth target, then this will likely double, because then the dividend will be increased, the debt will be lowered, this will look better and better, the outlook will be better and better. So it's all about, okay, will this negative sentiment now change? This is IBM. It's likely due to the moat, due to the name, due to all the clients, that the dividend of 5-6 billion is pretty safe. So if you are a dividend investor, this is an interesting opportunity, especially now that the sentiment is so bad, because after all, it is IBM, Big Blue, and a little bit of red now after the acquisition of Red Hat. So you have to see how this fits you, but if you really want to watch this through the ugliness, you have to watch, okay, when will this start improving? The technologies are there, a lot of interesting technologies for the future, so there is still some quality, but there are also issues, and therefore it's priced like it is. If there would be no issues, then this would be a 30 price-earnings ratio, 30 dividend yield of 1% company, but it isn't. Perhaps the stock will return, as we said, and I have made this chart and put 20% chance on it going higher, doubling, on 5% steady growth over the next few years on hybrid cloud, 60% change of it staying in this range saved by the dividend, and a 20% chance of a dividend cut and down to 60% on even slower growth, losing that market share to Amazon, to all the clouds operators. I personally will not invest in IBM and will not even follow it because it's ugly, and I think I can find better, and all those following my stock market research platform can see what am I looking for: a little bit more of growth, and especially more certainty of growth, opportunities of future growth. And in the tech there is so much competition that's really hard for companies like IBM to do well. But most importantly, I look at the management and I think, will you be able to beat all the others, you that think about margins, etc.? I don't know. I personally just didn't get a feeling, but this tells me, okay, this could be a good dividend yield. It's most probably that the stock will do well. The dividend is great, 5%. So at the end, it's just about how this fits you and whether you want to follow it. I wanted really to check it because when something is hit hard, I know that there is a place to find opportunities, but I simply didn't get a feeling with IBM. I hope this saved you a lot of research time. If you were interested in IBM, you can check all my other researches in the link below in the description on my website. And these were just an example of the last stocks that I looked. Thanks for watching, and I'll see you in the next video.